Hi, this is Randy Finney with Right Side of the Chart. This is a closing market wrap for Tuesday, May 12th, 2020. As I stated in the last update today, I posted an update on the SPY trade. I had to cut out of the office today a little before 3 o'clock, so I missed the last hour of trading. And of course, we did get a pretty decent slide in the market, so we'll talk about that a little bit and tell you what happened today technically, what didn't happen, and most importantly, what to look for going forward. So what did happen is we had a nice slide into the close. This is after hours right here. We're down 2.75, but if I turn that off, it tells me that we closed the day about 2%. So the SPY, went all full circle today. It was green at one point, I believe, and ended up closing down about 2%. Now, what happened technically, let me put on the post-market trades again. What happened technically, we broke that smaller wedge. Remember, the bigger picture is this. I recap this because I know some people come in, don't catch up on the updates day in, day out, maybe when something big happens. This was our big 60-minute rising wedge. It was a basis for the, well, one of the short, we shorted back, I forget where that entry was. We've been short the SPY for a while. But we got caught in this sideways choppy trading range, which we're still in. So again, bigger picture, that's it. We're still in the middle of this multi-week trading range, so can't take too much from today, but there are some things to watch going forward. Now, what we did do is after the breakdown, we've so far corrected mostly in time, more so than in price. A lot like the highs back in February, what I went over in today's earlier video when the market put an all-time high. I was watching the same type of wedges on the 60-minute charts. They broke down. And then at least the NASDAQ 100, maybe the SPY went on to make a slightly higher high, and they just extended the divergence. And that's the same thing here. We've been extending these divergences, and that's one reason I've been, that and the fact that the market's not gone anywhere, and most importantly is struggling or failing so far to take out some key overhead resistance levels. We rallied back into those. I'll get to those on the daily chart in a second. So what happened here, at least on the 60-minute chart, is a breakdown of this smaller wedge and an impulsive move down. And you can see it in the after-hour session, they parked it right on this 283.90 support level that I've had here for a while, and so to be continued tomorrow. We'll see where we go. Let's see. Let me show you QQQ. The Q's down about in after hours again 2.61. If I turn off the after hour, they closed down 2%, a little over. That's what it looks like. Same story. We had the primary 60-minute uptrend line was broken. Q's just like they did, as I covered in today's earlier video, back when they hit their all-time high in February. The market did. We had after the bigger wedge broke down, we pushed up into made a marginal new high, but still a divergent high, still an extension. In other words, the bigger the divergence, typically the bigger the correction. Here was a little small divergent high, relatively, relatively small correction, about 6-7%. It's worth trading, but now we have these multi-week divergences building, and we had an impulsive move down, but again, we're right at, you can see right around that 220-ish support there. So again, work to be done, but let's look at the daily chart. That's really where the focus, I think, should be turned right now. On the Qs and on SPY, what stands out to me, we have bearish engulfing candlesticks put in today. That is when you have a big red candle like this, and the body or the fat part of that candle engulfs at least the previous candle. In this case, you engulf the previous two candles, or at least the bodies. That's what you're looking at. A bearish engulfing only needs to engulf or cover the body of the previous candle or candles. So we engulfed two candles there. On SPY, we did the same thing. Bearish engulfing candle, and what's more significant here on SPY is where it happened, where this impulsive reversal happened. Again, as I covered in the video earlier today, it happened at a confluence of resistance. We have some price resistance. There's a big gap there. We have the 61.8 Fibonacci retracement. That means that's the S&P 500's retraced, that's a key Fibonacci level, and it's retraced that percentage, less than, it's less than 2/3, 61.8 of the move down off the highs. And so a lot of traders look at those, trade off the fibs as well as that 200-day moving average, and so that makes that significant because I came home, I glanced, I didn't see any headlines that attributed to what the drop was, due to. And, right now just natural selling. But again, I don't read too much in any one day. To me, I'm every bit, if not more concerned, what happens over the next few days. So let's talk a little about the bearish engulfing first. Those are potential topping sticks, and you want to look for them after a prolonged uptrend like this. That we have the uptrend off the March 23rd lows. And when I say potential, yes, that is a bearish engulfing, but I like to see it confirmed with follow through. In other words, ideally, not absolutely necessary, but by far much gives you a much higher probability that's a topping stick, meaning that we're going to start now a new downtrend if we have a solid or at least a red close below. It doesn't have to be solid, but as I like to say, the redder the better, meaning, to get a big red close tomorrow, big red candle, close well below that level, all the better. Second consecutive down day would be even better. Again, doesn't guarantee anything, but it helps. If we close up green tomorrow, why is that not good for the, at least for our short trade? It's good for the market, at least could be. Well, number one, it negates that bearish engulfing candlestick, takes away from it because now you can't have a candle over that or it's not a topping stick. Number two, it's going to take out the 200-day moving average. I went over that quite a bit recently, very big level. And we're also going to move above the, that other resistance levels, price resistance, that big old gap back here from the gap down after the March 6th close. A lot of stuff happened around that point. So that's it. This remains a battleground for bulls and bears. And again, I don't like to get excited. So I typically say don't get excited, but it's somewhat encouraging because we've been in this choppy trading range for a while, but we still need to take the bottom of the range out to really, say with confidence, hey, okay, we're gonna, go on and hit those, or the final price targets, longer term price targets on the SPY trade, which again I may very well increase those targets, add additional targets if we get anywhere close to T3 or T4. I'm talking about this trade right here. These are third and fourth target, which is currently the final target. But if we start to get close to that level, I think the odds are going to be pretty good. We're going to make a run at down towards or possibly quite likely below the previous lows back from March, and therefore I may add additional targets. And that's also why I've been a little more willing to raise the stops above my preferred 3-to-1 risk-reward ratio. Right now, it's a little under a 2-to-1 risk-reward ratio, meaning we're risking about 8% downside, a little less than, I forget what it was, I know it's under 16, 15, 12% or so to that target. Again, from our entry price, not from where we're at right now. If that fourth target's hit from where we're at now in the after-hour session even, which is about also a percent lower than where we closed, you're talking about 17% or so. Okay, just rolling back to that daily chart real quick. I'll just, eyeballing this chart when I go through, I look for these corrections. You can see, go back in time, and here's one right here. I'm going to zoom in. Let me grab this chart, show you another bearish engulfing candle. That was back in around this time last year. There it is, May 1st. We had a bearish engulfing candle on the SPY, and there was your confirmation of follow-through red candle. They tried to kick it back, but failed to take out that bullish engulfing candle. And from the highs down there after that day, if I can grab that high, it should snap to it. It might be at the top of the candle, not all the way at the daily high. But that was still oh no, I'm sorry. Before all was said and done, it was a 7.5% drop or so. So there's one example. And sometimes you get them. That was not a bullish engulfing. Oh yeah, there was a bullish engulfing. It went down 3 days, but it didn't really lead to anything. Or 4 days of a drop. It was a decent correction, but again, it didn't really give us a trend reversal. This one back here did, at least a near-term trend reversal. So again, something to watch. But more importantly, if they foil that and take it above again, there's a lot of resistance they take out, and it's not the nail in the coffin for the short case. because you have quite a bit others. You have the 200-day simple moving average and price resistance and other things like that ahead. But it just would be ideal at this point. It would almost be textbook to see more downside and to have this rally end at today's highs, or well, I guess technically speaking, it was last Wednesday, the 29th of April, is actually when the high so far on the SPY was. Okay, two more things to look at there. PPO, we have a very close potential or a pending bearish crossover. That's when the PPO line, this orange line, crosses down below that white line, the signal line. I've talked about this recently. In fact, I'm going to put up a histogram so you can see it. This histogram down here will just show us, let's put it up top here. It'll show us when those two lines cross. And it also shows you the differential, the distance between the two lines. The higher these bars are, or lower down here, the farther they are apart. And so when you cross a zero line. So you can see right now we're at 0.03. So any more downside tomorrow will do a couple things. It's going to confirm, especially a solid red close. Even better if we can get more follow through in the next couple days. It will give us a bearish PPO crossover. Now keep in mind that will be the first bearish PPO crossover since right here. That was a golden one. Sometimes they trigger. I always say this: stay away from using trend indicators like this when you have very low volatility and hardly any separation in the lines. You can see here these lines are flattened out, so you're going to get whipped to pieces when trying to use a PPO histogram to give you buy and sell signals. But when you have these clean hills, clean separation, it does a pretty good job. And I've gone over that in recent videos. If you just use this by itself and shorted when you got the crossovers, and then covered your shorts or went long when you had the bullish crossovers, that in itself is a pretty decent strategy. But again, when you see volatility almost vanish in this low price compression, whether you're grinding up or grinding lower, you usually don't grind lower in the market. It usually inches up and then waterfalls down. But my point is, that's when those trend indicators don't work well. But they do work very well in periods of high volatility, in these sharp trends like we've had. And so you look for these big hills. And again, that was the sell signal right after the lows there, divergent low. We had buy signals on trendline breakouts, everything else back then that were highlighted. But you also had the follow through with the bullish PPO crossover right here. And so that's something to note right there, is that we're looking at that. So these are and again, this is a daily chart, so these would be some technically significant events that I'm on watch for. They may or may not happen this week, but the charts, still to me indicate that they will likely, or I wouldn't have given this trade so much rope, and I'm giving it rope more so in time than in price. Again, don't confuse that. Holding on to a trade that's walking against you strongly. There's nothing wrong. Sometimes you have to be patient in the market. And as I talked about, prior bear market rallies stopped around this point. But what happened is they usually tested the 200 days for 200 day for several weeks or more. It was not a one and done thing in just about every instance. And so this kind of fits with what, should have happened. Now you might ask, well, why didn't I just wait? Well, first of all, I didn't know we'd get a full test. It was never a guarantee. And second of all, who knows? Every time is different. So you can only short at objective levels or go long on breakouts of objective levels. Like I said in today's earlier video, if they can pop this, print a solid close, especially a couple closes, the farther they get away from that level, there's an objective long. If you believe the market's going to new all-time highs, go long there and set your stop a little bit below the 200-day. Quick look at the futures. This is what we've kind of been same thing. This is a 1 month chart, and we can go back. I'll pull it back a little longer. These are hourly candles. So this is kind of the slow roll of the momentum. I mean, this is where most of the gains were made. This is where we had longs back here and we're bullish, and then I started, getting out of those longs and going towards a short bias here, given too early. But again, mostly too early in price, because if you look at it this way, this is the rate of momentum here. The big moves were made there. In fact, that's at this point, this is where almost all the gains were made on the bear market rally. We're actually, here, I'll zoom back a little closer, 2 months, and you can see we're right back in one fell swoop to where we were. Let me get there. There it is. This was April 16th. Okay, today is May, what is it, May 12th, I believe. So almost a month ago, and we're below that level now. And that's it. So we went a little bit above it, a little bit below it, a little bit above it, a little bit below it, a little bit above it. So it's frustrating. I know. I've learned, I've done this long enough. You just have to, be patient and just be objective about your market, your trades, and, don't hold on to them if they're going against you in price too long. But if they're going against you in time, I have no problem with giving a little rope, a little, plenty of time, as long as it takes. Really, it doesn't matter. We're not going to trade sideways forever. All right, NQ. And levels to watch on ES. I'd have to mark this chart up and study it a little further. Let's see if we have a trend line that we can look at here. I'm just going to kind of play around with this chart. I'm just eyeballing these reaction lows here. Wonder if we get a trend line going like this. Possible. Not a lot of reactions. You can see a bunch of horizontal levels, but the bigger picture, what stands out to me is just this multi-week or or month plus, several weeks, multi-week kind of sideways trading range there. We've been boxed in, popped a little bit above. Maybe we can even say that's, the top of the range right there and do it like that. So that's what we need to take out, the bottom of the range. Anything else in between, maybe noise, we'll see. Meaning back and forth chop for a while. NQ's been stronger, but again, NQ is the Nasdaq 100 futures. Although it is technically an index, as I said, it's not diversified like the S&P 500 or even the Russell 2000 small cap index or the mid cap index or anything like that. You have most of your stocks here are tech stocks, and then the weighting is very heavily geared towards just 5 of the big huge FANG stocks that are $1 trillion or close to it in market cap. Everything else, and the returns, because it's a market cap weighted index, so you're really looking at a proxy for those FANG stocks here. But they are the market leaders. They're also top weighted components in the S&P 500, so we watch this. And what you have is, we've been inching higher. Same old story. I've been drawing trend lines, and one breaks, and we get a little sell-off, and we back test. And I could probably put up, what would fit here is Fibonacci fan lines might work well. I don't know. I don't think this charting program lets me put up Fib fan lines. I can do it on TC2000, but they look like this, and they're spaced on the Fibonacci sequence, and that's a lot of what they look like there. And then this final one right here, you can see this most recent trend line broke today before the close, and then boom, that was it. And I had the first support level here at 91.11 and change. We actually went down through there and closed below it by a pretty decent margin. So now that's resistance. So overnight, that's the level you want to watch. Bulls want and need to take that level back, whereas if they can't, and I could tell you, it's objective if you want to short a kickback to about 91.11, 91.12, whatever, with a stop somewhat above. That's, just contain your losses if it pops above there. And then the next support, I've maintained this one, 89.56.50 or so, give or take right there. But you can see, just like there's a lot of resistance overhead on the daily charts, on these 60-minute charts, there's a lot of support levels below. But we'll see. So each one, should come into play as resistance. Sometimes they don't. And when they don't, that's pretty darn bearish. So I would expect if we get to 89.56, a reaction. And if we blast on right through it, then something else is going on, and we'll see. Just flip back to the QQQ 60-minute chart. Same story. I think I already talked about that. That's what it looked like back when the market topped in February, almost identical. We had the same thing. Day after day. No new change technically. Another divergent high. Trend is bullish, no doubt about that. We even had mostly longs back then leading into those highs. But then, as I said, I was warning those divergences. If when they play out, they'll lead for a correction, and they did back then. Actually led to that 36% drop in the broad market, but that was a technical catalyst, and we kept going, and we blasted right through some of the key support levels and kept going. So right now, again, nothing to get excited about, but it is one of the most impulsive sell signals we've seen recently. Since right about here, we had an impulsive drop there, didn't really lead to much else. Thought, at the time it might, but it didn't. We kind of grinded higher, so that's why I want to see, did we get follow through here? And if we do, purple lines are pretty important levels here. So you have one right here defined by those dual gaps, gap 1, gap 2, and then this I think is still a pretty big level, about 211.33. For weeks now, that's the purple line. I said that needs to really go to open the door to a much deeper sell-off. So those are the levels we'll watch, the near-term levels if you're a QQQ trader. Small caps, IWM broke support. That's the lows back in March right here. You can see we had a comparable uptrend line working there. You also had divergence right here recently, negative divergence, and we broke that trend line today. So unless they can recover it, if they can recover it, any new high soon would still be just an extension of those negative divergences. So it's not going to change anything technically, and you have a big gap. I covered IWM in today's video, so let's not spend too much time there. MDY, that's a mid-cap ETF. That's a 60-minute chart there. That's what it looks like on the daily. Same thing. PPOs pointing down, look poised to make a bearish crossover. Probably the same thing on IWM, but it hasn't done so yet, so we'll watch that. We'll see if there's any more follow through. Okay guys, we're right at the 21-minute mark. I can wrap it up here. This is just a different board of the 60-minute chart of SPY. Remember our official short trades based on the 60-minute chart. That's pretty decent level right there, 278.42. That's why I've had it color-coded purple for a while. We need to take that out. So look for, that would be a near-term target. If you're looking to just take quick profits on a short, or you're long and you want to look where to buy, you can step in at 287.42. Again, I have no desire to gain bounces here. I'm in those swing trades and holding out for more downside to come. But I just want to point out these are the levels here: 278.42, 270, 182, and then 263.93. We'll call that 264. Those would be all within the realm of what could be if the market is going on to new highs, which I don't think it is. I've made that clear. I think I'm pretty clear on that for a while. Those would all be normal and healthy levels for the S&P 500 to pull back to. So if you're long, maybe you scale in a little here, a little here, a little there, with a stop not too far below. If you're bearish, it all depends on your time frame. If you're an active trader, you want to try to game this, but game bounces off these levels, great. But we could have a crowded rush for the exits. I think this rally has been carried up to the upper limits of where it probably should be, if it is what I think it is, a bear market rally. And so I don't intend to try to get cute and game these like I might normally, at least on my swing positions. I don't want to double speak, but sometimes I'll put on my active trader hat. I haven't done that for a while because volatility has been so low. It hasn't been conducive to day trading, so I haven't been posting day trade setups in the trading room like I often do. And that reminds me, I told you I'd stop at the 21-minute mark, but I mentioned volatility. I might as well talk about TVIX trade. They tried. They came real close. Look at our stop right here. I had a stop on a daily close below 134.97. They took it down today as low as 131.79. Thank goodness I kept this as a stop on a daily close, and you can see why. This is a market like this, that just try to squeeze and run the stops where most of them in place. So if that is what happened today, if we've seen the final capitulation on the shorts and more new money coming into the market on the long side, on that reversal today, we could have some more follow through. The TVIX trade, as much as we reversed off the lows, where did we go? That's about a 40% reversal off the lows. Remember, that to me, I have no desire to take profits yet. I'm, at this point in time, at least holding out to T1. Here's a potential trend line that comes into play that might, based on, because we got in this one a little bit early, so it's possible that may be where we get a reaction. But what I think will happen if we get follow through this week, here's my thoughts, no guarantees. If especially tomorrow, some more downside, we could pop through there. Even if that is going to stop it, this trend line I just extended, we'll probably get a momentum fueled overshoot because the VIX is very volatile, so it'd be a lot of upside. Maybe pop, hit our 247.94 target. There's the actual resistance level. I set that one pretty tight. And then close the day on or have a reversal off that trend line. So it kind of, here's the way I see it in my mind's eye, something along this, like this, this, this. But you have to define your trading style. Are you an active trader? Also, how far do you think the market's going to drop? If it does, if you even think it's going to drop, and if you think it's going to hit those final targets or more on the SPY short trade, then you might just want to hold on to this one, because as we learned before, we were long the VIX right here off that low. We had it at same thing. We added it too early back then as an active trade, went long somewhere here, hit our first third targets. I had a potential target up here, and it just kept going. I mean, I forget what we were. I know we were well into the double digits. That the third target, I can't remember exactly where it was, but even that potential fourth target was about a 200% run off the lows. But look, if we would have, in hindsight, I probably should have just trailed stops and let that one run, but hindsight's 2020. There's a 2,461% return off the lows in TVIX. Is it going to do that again? No. I already went over that at the time. I said I doubt that may mark the high. It was equal to the high back in the 2008 bear market in the actual VIX index. But I said back then the VIX peaked well before the stock market bottomed. So that's the thing. That's why I mentioned that back here the next opportunity on the TVIX would have been to short it. But obviously this is where we went long for all the reasons that I posted on that trade, falling down to support recently here. All right, let's wrap it up, guys. I had an extra 5 minutes, but I did want to talk on this because the VIX and the stock market short trade go hand in hand, and we'll see what tomorrow brings. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.